Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Everyone writes books about how to make money in the markets. Not many people write books on how to lose. It's probably not good for sales. Here, look at me. Learned how to lose like I did. That's not going to sell very well. But the truth is really you all heard it. To be successful, you have to limit your losses, right? Isn't that learning how to lose correctly? Well, certain indicators, certain products, trading certain strategies can help you to do that. Like using option strategies. If you're bullish the market, perhaps instead of buying outright calls as a directional trade, perhaps the market goes up, not enough, or the deltas were too low, or theta kicked in and you didn't see enough performance in the market price in the prescribed period of time. Well, guess what? Perhaps a different option strategy would have done better for you, and such as perhaps a credit put spread. By using the ISE's products, you have the availability with a little understanding of some options with today's presentation, at least an eye-opener, in identifying certain techniques to help you identify changes in price and momentum. So I would have to say that, quite frankly, with currencies, we definitely see trending market moves. Because of the very nature of currencies being dictated by interest rates and government intervention as far as monetary and fiscal policy changes. If you look at the ECB or the Federal Reserve here in the U.S., they're not going to change interest rates overnight. There's going to be a shift, but overall, there's really a time when we see periods that interest rates stay low for a period of time and interest rates stay high for a period of time. They don't change every hour. So therefore, with trading in foreign currencies, it can give the trader, at least even a stock trader or an option trader, some pretty good opportunities if you know what to look for. So with some of these indicators, and I want to mention and go into with stochastics, many of you, if you are familiar with me, I'm not sure how many people here are familiar with my work and some of the stuff that we've done. Do we have any people out here? Okay, great. For those who aren't familiar with me, I started back in the floor of the Chicago Mercantile Exchange in the late 70s, and I had the opportunity to work for a guy by the name of George Lane. George actually is the man credited for creating and developing the stochastics indicator. So I have firsthand knowledge of over 30 years of what went into it, how it works, and what makes it work best. Stochastics is virtually a range-based oscillator. It's a momentum oscillator indicator. It's based on a mathematical formula that's computed to compare the settlement price or the close of the current bar to a specific time period of the price range of a specific number of past periods. In other words, it measures the current close as it relates to past highs and past lows. That's the very nature of the indicator. And it gives us overbought, oversold readings. In other words, it helps us to identify when a market may cycle out on a high or cycle out near a low. And with that information, at least you have better understanding that if we're near a cycle low and that you finally have become bearish on the market, it may be more prudent to wait for a cycle high. What's important is understanding some of the rules of how to interpret buy or sell signals. Personally, when I look at readings when they are above 75 and percent K and D are both above that level, when percent K and D crosses over the D line, that's when I look for a hook, and both the K and D need to cross and close back underneath 75%. So that helps generate a potential sell signal. The exact opposite is true to generate a buy signal when the percent K&D closes below 25%. When both lines are pointing up and close back above the 25% line, then we generate a hook buy signal. Another method that we're going to talk about today is using the stochastics for bullish and bearish convergence. Those are some of the very important identifying aspects of understanding chart patterns. If price makes a higher high, but indicators makes a lower high, it tells us that potentially this market or the current phase or bullish phase of the market may be coming to an end. So therefore, the market price itself, we want to identify comparing the indicator to the actual price of itself. And we'll move forward. Here's an exact example. As we can look in our bottom quadrant of our screen, we notice that the stochastics has crossed below 20%. The market is starting to move even in price a lot lower. But notice that the stochastics is starting to generate a higher low while price is generating a lower low. And all of a sudden, we start to generate candle patterns which show us bullish potential reversals such as the hammer pattern. So quite frankly, in today's presentation, when we're doing a seminar like this for the ISE, what we'd like to do is to indicate to people a technical indicator that they can use with all aspects of their trading. When you notice that the stochastics, as we see the hammer pattern, once the stochastics indicator crosses back above that 20-25% level, notice it really helps to initiate the bullish thrust in market prices. So instead of catching the falling knife, using the indicator and bullish convergence will help you as a trader to start to set up a trade. I think one of the important things for traders is that they either get into the trade too early or they get out of the trade too early when it comes to winning trades. And so especially for options traders, if you can learn to time directional trades a little bit better, because you get into a trade and all of a sudden the market finally moves, but if you're too early, because of the time decay, you're not going to see performance in your option values. In fact, it can be very frustrating for a lot of traders. If you want to trade and sense that the market is potentially coming to a reversal or a consolidation phase by identifying bullish convergence on stochastics, then you can start to pick out in your arsenal several different option strategies, which is really neat with the ISE's product because, all the options, they're electronic, they're easy access, they're well balanced as far as volume and liquidity is concerned. So you can start to possibly say, okay, this market's going up. I'm not sure how high it's going to go, but I believe we're going to base out here. Now's the time to maybe look at a put credit spread. So a trader can start to use technical indicators to develop better strategizing techniques as well.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.